And so it is easier than maybe last year, which was tougher for us in a big picture sense. So, we run a long short fund, which means we are long some stocks and short some other stocks. And our net exposure to the market is quite high, around 70 odd percent. Generally, we've had 62%. So we never have cash. And the reason for our outperformance this year, one big reason could be that we have a higher weight in consumer and financials and a lower weight in IT. In our case, we have zero weight in IT. So that is how we are positioned, which means we are still not buying IT stocks in India. And we have a overweight on, and that money has been basically invested along with the normal allocation into financials and consumer stocks.
Okay. So this is how the portfolio is at the moment, and you say about 70% of the money is into long equity. Apart from these sectoral bets, how do you see the market from current levels? All your friends sitting in Singapore have been coming out with macro reports pointing to better and longer durations of good times ahead for India. One, would you agree with such reports from Morgan Stanley and Goldman Sachs? Or do you have a different view on the market?
No, actually, we have had a longer term view on India than maybe Morgan Stanley has, which has only recently gone from market weight to overweight. So the big picture story is that India market in dollar terms has actually done well over the past 5 years, 10 years, 15 years, 20 years, and 25 years. Actually, over 20 and 25 years, India is number one in the world. And over 5, 10, and 15 years, we have done better than mostly all other markets except US. So first thing is that India in general as a market has delivered in the long run in the past. And these things that are happening now, which people make it feel that this is therefore building a base for the future, the way I look at it is that this is giving me assurance that the kind of returns the market has delivered, we can again make in the future also. The returns themselves may not be much higher than what we've got in the past, which is broadly at an index level in the range of 14, 15% per annum. So if even that visibility improves and the volatility reduces because now we have foreign investors buying and Indian investors also wanting to buy or buying, the returns may not be materially different in rupee terms, but we are also hoping that in dollar terms, the returns are a little better because in the past, this 15% return in dollar terms, basically we lost around 4% per annum. So if we can in future lose only 2% per annum on currency, that itself is a big positive for the world to converge into India.
Wonderful. And Samirji, there is no better person than you to ask this question since you are based in Singapore and you deal with the entire Asian investment universe. China plus one is what India is touted as. And over the last 2 or 3 months, I am also seeing a lot of reports where people, companies, and big ones at that, are voting with their feet when it comes to moving money away from China and bringing it into India, whether it is in the form of FDI and FII. Is this a trend which is here to stay? Since you do a lot of macro as well, how would you see a global allocator of funds on the FII side and a company which wants to use India as a sourcing base over the next 10 years?
Actually, if you want to reduce it to one line, this is the story. The one line story is China plus one. You can look at it both from the FII, that is the portfolio investor, and also the guys who want to set up supply chain, their operations, production, etc. in India. So the first one, which is the FII part, is easier to understand that it is happening because the investors are frustrated with their returns from China. So in the last 25 years, the returns from China would be less than 2% per annum, and this is when you say that their GDP went up whatever 9-10% per annum. So it has truly disappointed investors because of various policy actions where the returns were made and then lost over the last 4 or 5 years. And now people are so sick of it that in newspapers like Financial Times, every third, fourth day, there's an article on how investors want to cancel China and how investors are looking for China-free benchmarks. So these things are very big now in the sense that even people are willing to name themselves as that we are not investing in China. It is not being said by people who refuse to give their name kind of stories. On the other hand, in terms of the FDI, that people have realized after COVID and maybe around other issues that it is too risky to put all your eggs in one basket. That if there is some zero COVID policy or some technical issue, or US, which now considers China as a threat, might sanction or might blacklist or do whatever. And also from our side, that is India side, that we are offering a big market, but also on the other hand, saying that if you don't make in India, your either your license requirements are tougher, or that you'll have to pay duties, or you will not get that 10, 15, 20%. I mean, you'll basically have this make in India duties kind of thing. That it is also logical for many of them to make in India, maybe to meet the government's demands first, but over time become comfortable with the Indian system and production and labor, and therefore make out of their own volition. So overall, both the groups are interested in India, and you can see that in FII flows, and you can see that in announcements from Apple and others, and everybody wanting to build sort of at least the new growth, maybe a little bit more via India production rather than China production.
Wonderful. That somehow sets the macro trend for the show. Now let's drill down into our markets. Mr. Arora, we've seen this fantastic rally that's enveloped us on the new age companies, the ones that had disappointed us very, very sharply in 2020, 2021 because of the way their IPOs were priced. I won't name any of them because that will be an issue in terms of regulations for you to comment on. But as a sector and as a structural theme, the new age companies, whether it's the internet based one, are they on your radar when it comes to putting money in them? Are they at a position where you feel now that they are good enough for at least a medium to long term punt?
So we actually bought two of them, and I can give the names. I don't mind because these names are we have said publicly in a few other interviews, which is Zomato and Paytm. And by chance, we bought both of them at a good price. Both of them were down some 60, 70% from their peak. In the case of Paytm, the IPO price was the peak. And we bought it maybe 75% lower than that, around 500. So the thing is, both of these have had massive rallies. We still hold both of them. But still now the prices are very different from what they were 5, 6 months ago. So please be cautious. But in general, even in the others which we don't own, but we should have owned, even those stocks have done well because, as you said correctly, the biggest thing that was wrong with them was not their business. It was that the private equity guys were trying to extract too much of a premium for listing them in those hot days of 2021 for new issues. And therefore, that punishment has been taken by people who did not look at the price but only looked at future prospects. The future prospects actually have become quite okay now, as the other weaker companies have basically gone out of business. So if there were, let's say, I don't know, but let's say there were 50, 60 fintech or maybe 100 fintech companies in India 2 years ago, private that is, maybe now there are 10 or 20 left, of which right now 1 or 2 only are public. So same thing in food delivery, where there must have been at least 15 companies that were funded and now only 2 are left. And therefore, like that, even though the business might be whatever it is, but the competition has come down. The competition from private equity funding new startups who are willing to lose money for many years, that has died down. So whoever has survived, and these guys, I mean, by the time you are listed, mostly you have survived.
Yes.
Then you get the future prospects and growth. But it's very different from 6 months ago when we were buying them. They were really not the obvious choices. But even now they are sort of not obvious, but we still have them and we will have them for some time.
Okay. So Zomato just turned turned into a profit, whether it was just 2 crores or not, but you know what the trend is, and when you shift towards profit, especially in equity markets,
Correct.
that's where you make the maximum amount of gains as an equity investor. Just recently today, Mr. Arora, we had this news coming in from Paytm that its Chinese parent has drastically reduced its stake by half, and that stake is shifted to the Indian promoter. You think these are macro events which are guiding both venture capitalists and Indian companies to shift ownership to some extent back to India?
No, this one I think is more to do with the regulatory issue that because of Chinese ownership being more than whatever 25% or whatever,
Yes.
that they were not getting certain approvals from the Reserve Bank. So this is a structured transaction. Hopefully, they have checked with the regulator, I assume, because otherwise they won't announce it. But this is more that now the owner on record is Mr. Sharma, but the economic benefits are still with the Ant Group. So this is more to meet the regulatory requirement, but it also gives two signals. One, that if people thought that to reduce the ownership to so that the Chinese stake is below whatever 25 or whatever percent that Ant will have to sell, now everybody will take it that for 2 3 years they won't sell. And B, it means that also if there were any approvals that were stuck because of that ownership, that those restrictions are gone, so those approvals will come. And thirdly, it means that the Ant Group also doesn't feel right now that they should sell. Otherwise, they could have just sold it and walked away, which also would have been positive if somebody else had bought it and not have it just as an overhang. So it is positive from that angle, but it's not a real ownership change from the point that Mr. Sharma is now putting up personal, whatever, $600-700 million to buy a 9% stake. But obviously, that would be very tough to organize.
Okay, let's shift focus to a couple of sectors in India which have shown consistent returns. I'm wondering whether they are on your radar or not. We've had this budget related move on railways where a lot of funds have been allocated for not only future growth but also existing expansion in terms of better quality of rails, better signals and all. And that's reflected very well on this entire railway pack, whether of PSUs or public sector companies. Is this on your radar? Is Helios a part of this rally? Or is it again one of those stories that you buy PSUs when they are dramatically cheap and you sell them when they become mildly attractive?
So, you said that I have been around for whatever 28, 30 years, and everybody does this in the first 5, 7, 10 years of their life. And then I also did it in the 90s and early 2000 when we would even look at the railway budget, and then we would read what people are saying about signaling systems and security systems and safety systems, and then buy those stocks. They never ever worked out for us for even a day. So right now we don't look at anything where government is the customer, because government is a customer is generally at low cost, lowest cost, L1 cost. Secondly, normally these things people don't get paid on time. Thirdly, you don't know whether the foreign company will get or some joint venture company will get or our listed company will get. And for getting one order out of 10, we don't want to buy these stocks. But broadly, we have realized that there are so many companies that are out there. We don't want any company where even one or two factors are negative. And we consider government being the customer as a negative.
Coming back to consumer and financials, you've been possibly the longest holder in private banks as far as I can recall. And they've come up with some of the most fantastic numbers in recent memory. When it comes to India's financial sector, do you think we still have a lot of momentum left for the next 5 to 10 years? Because this is a capex led move. Where do you see value in that particular financial segment, the private sector banks?
So financial sector or private sector banks particularly have done well because we started with very low penetration of banking itself, and secondly, the story came that, which is what I got right from the 90s, is that the private sector banks will compete with public sector banks or state-owned banks and also gain massive market share. And that was the story of all these HDFC banks and Kotak banks and all these other stories, which we got right. Now, over time, the penetration has happened, but still there is a public sector market share to lose over time. Maybe State Bank is still very good and Bank of Baroda is very good, but other banks in the state-owned banks, I don't think that they are able to handle the new millennials and the app-based consumer and the consumers who want to do things online. And therefore, there will still be market share to lose over time for the collectively for the state-owned banks. And so many banks exist, we don't even know why they are there. So all that market share will go away to the private sector banks. And in any case, banking grows at some 1.5 times the GDP. Even today, you look at it in the US, Warren Buffett still owns Bank of America and many people own JP Morgan. So these things are not 5, 10 year stories. These are stories that go on forever. According to me, three stories go on forever, which is financials, consumer, and IT types, because something or the other in general, I'm not going Indian IT right now for 2 months, but in a general sense, these stories are forever. Sometimes maybe little bit overweight, little bit underweight, but these are very, very good long-term stories in any market.
So, what do you like in the consumer space? This is, one of those really highly valued, highly priced structures in India. Over the time, we've never seen FMCG become cheap in India. How do you redefine the consumer in this time and age where people are talking about $2,500 per year as Indian per capita, and that is probably changing the landscape of how we buy, and what we consume?
So basically, the biggest thing that we have avoided in general, other than owning ITC for 2 odd years, is consumer staples, because we don't like these 8, 10% type of growth. Because our market or our GDP grows in rupee terms that much or more, and why should we pay? So there are many consumer companies which grow 20%. Some of very rarely they grow 30% these days unless it's very early. But here we bought for a long time. We own Westlife, we own Varun Beverages since 2019, we own Westlife since 2016, and then we own this Vedant Fashions. We basically want higher than 10% growth. We want 18, 20, 25% type growth rather than 8, 10% growth. And even though that obviously will not be for long, but maybe 3, 4, 5 years, sometimes they go on for longer, we are willing to pay a little bit higher for that than to buy 10 odd percent revenue growth, because that to me looks like this India's growth. I want higher than India's growth. And that mostly happens if the sector is under penetrated, big picture. If it is penetrated, then the growth rate comes down to India's growth rate.
That's fair, and probably a lot of old world FMCG companies like Lever, Nestle, and Godrej Consumer have barely inched up beyond 10%. Before I ask you a lot of questions that a lot of our viewers have sent, Mr. Arora, there are two more I want to ask. Where is the biggest alpha hidden in Indian markets from now on? And what is the mega trend that you are seeing emerging from our markets over the next 5, 7 years?
So the first thing about this alpha bit is that in you don't know ahead of time which stock would give it, except that you know a large number of stocks beat the market. Our formula has been that we buy about 30 stocks, in which about 18, 20 stocks are relatively new. I mean, not new as in completely new, but not the HDFC Bank, ICICI Bank types, which we consider in the other 10 that we buy. And from these 20 stocks, many of them emerge, but you don't exactly know whose turn it is next. So, for example, we bought Varun Beverages in 2019, and then came COVID and the stock fell maybe 30, 40%, and since then is up some 7, 8 times. But how would anybody know in 19 that in 2022 or whatever they will come up with this drink called Sting, and that the Sting will become a big hit? Or how would we know in 2016, since we own Westlife, that some 2 years later they will suddenly bring McCafe into their stores? Nobody knows these things. All you are doing is making sure that you are buying companies where you can't find any negatives. And the negatives could be that they are in a bad industry or in a bad theme or they are in a bad with a bad promoter that we know about, or we know that their capital allocation is bad, or their valuation is very high, or that time when we are buying for the next 2 3 years, their earnings are supposed to be below market. And then we look at some positives. You won't got everything positive, but you'll say, okay, this fellow has good history, or this fellow is really cheap, or whatever. And you, out of these 8 factors, none of them should be bad, and then some should be good. But all the 8 factors will also never be good according to us. And then we are buying 20 odd stocks and letting the statistics take over. This is like when you go to a casino. The advantage that the casino has over you is very small, but the casino always wins because if you play many times and the stats take over, it's the same thing. When we do research, it's not that we find for sure 100% magic that we found a stock, therefore we should put 20% in the stock because we have understood everything. Because next day we like the management, and next day the management will have a heart attack and die, and the story is over. The point is you want to not bet on luck. You want to bet on stats. That if you buy 20 companies, some X number normally do well, and you want to have that plus a few more. And for that, you don't accept even one negative. That is how we do. So we say you look at our 20 odd stocks, it is guaranteed, not guaranteed, but high probability that many of them will do well. And that is why over time we have done well, or whatever, very well, whatever is the word.
Well,
But
just say
not exactly knowing whose turn it is next.
absolutely. Just to put on record, not only has Mr. Arora over the long term handsomely defeated all possible benchmarks, but he's done it with such a smiling face and such a wonderful personality that it's always a pleasure to sort of interact with him. Samirji, now we'll shift focus and get to the most difficult part of this show, which is the question answer session, which you so very kindly agreed to answer. So the first one comes from Mr. Govinda Tare. He's from Indore. He's asking, why are agri, pesticides, chemical sectors underperforming, and when will they regain their lost luster and momentum?
So agri and pesticide were never really doing well for us to say regain their luster, because generally it's a very difficult business. Any business, as I said, where there is too much policy making, government influence, things like that is one difficult thing. Second thing, in India, the rural India, agri India is very tough, very low income, very much subject to weather and things like that. So we have never really ever in 27 years owned any stock. Now the chemical sector actually did very well for some years, as it was again discovered as a China plus one theme over the last 3 4 years. But broadly we knew before that nobody would have touched any of these chemical stocks above a 10p kind of thing, and then these were taken to 30 and 40 and 50 and 100 p's. And one change here, one change there. China suddenly feeling that because of slowdown, they really don't want to give up all their chemical production, or Europe having a slowdown, and suddenly you can see most of these stocks have corrected big way. We own only one, and at the peak we own two. But these over time will come back, but they will not come back with the style which you saw for 3 4 years, because that was a bit too much for, you may call them specialty chemicals, but they are really just chemical companies, and nobody in the world gives 30 and 40 and 100 times for chemical companies.
Well, that was a bull run that has seen better days in the past. This is what Mr. Arora is saying. Let's shift to the next question. Mr. Subhaya Naidu, he writes from Amravati, Samirji. He wants to ask you how to identify sector rotation and what are the early signs of momentum in a stock.
So this question is difficult, but what I have learned over time is two things. That a company doing well, you don't have to preempt anything, because preempting is too difficult. But if a company starts doing well in the sense that for 4 or 5 quarters it is doing well on an annual basis, it continues to do well for number of years, which I call momentum of fundamentals. And therefore nothing has to be preempted. But if a company is doing well over 2 3 quarters, it is not the end of the world. It is going to do according to me for years. And similarly, when a company stops doing well, it is very wrong to jump in after one disappointment and say now that bad phase is over. Because normally if a company has been doing well for long, it tries very hard to not disappoint the market. And if it is still forced to disappoint, like say, okay, let's not talk about stocks, but if it disappoints once, it is very unlikely that after one quarter it'll come back and say, sorry, that not sorry, that good news, that was only for one quarter that I disappointed. It broadly then deflates, and the organization changes to adjust to the new growth rates. But there's nothing much that you can preempt. So I would think both, you can look at it also from a stock point of view. Another thing which I'm not following every day, but if a stock has done well for 3 months and it has done well for one quarter, that is for one quarter, and it is also done well for 1 year, by doing well means relative to the market. And separately, if you see that its numbers are also improving, it is enough. It'll do well for years. We bought ICICI like this in 18. Who would have known that this will just go on and on and on and still hasn't stopped? How would you know that? But you know, once you get the momentum of fundamentals and price together, which means the stock is outperforming for a quarter, stock is outperforming for a year, and the earnings are generally on the upward, at least on a year-on-year basis for 2-3 quarters. It will go on for a number of years in most cases, never in all cases, and that is why you need more stocks in case once in a while it doesn't work.
Samirji, I will write this question down in my own handwriting and stick it up somewhere on my notice board. It's such a wonderful answer that you've given. It's full of practical advice. And of course, none of it is theory because he practices it and puts it into action. The next question is equally interesting. It's from Mr. Vineet Joshi, and everybody has a stake in this. He asks, how long will this bull run last? When should we start taking chips off the table?
So first thing, according to me, there has been no bull run yet, because you are calling it a bull run because you are starting on March 26th or whatever. If I look at it, as I said, on an annualized basis, the returns from our market in rupee terms over the last 5 years and 10 years and 15 years and 20 years and 25 years have been broadly in the range of sometimes 13-14%. And then I think if you do it from 2000, whatever, 20 years, that is 2003 to now, it may be 17% per annum. So let us say it's 13-14% per annum. Now, 7-8 months are over, 7 months are over, and the index is up right now year to date 8.9%, more or less in line with its annualized returns over any longer term period. If you do it, also add last year to it. Last year, the index was up some 2-3%. So over 19 months, the market is up cumulatively 10%. If you say, now let's look at it in dollars, the return since December 2021 is zero. Because last year, the rupee depreciated by 10%. So this is not a bull run. If you want to see a bull run, please see what, like our Alliance NAV went up in 99, 280% for a mutual fund. And in 2005, 6, 7, the NAVs were up on average 50% per annum for three years. And this is not a bull run. You must be some young person must be asking this question. This is not a bull run. It is just a start.
So,
What is normal?
so if this is a start, then where are we headed, sir?
No, so as I said, as long as over long term you're making 15% per annum, which by the way, you are most welcome to right now go and check last 5 years annualized return. It will be around 13% per annum at the index level. Also, another way of looking at it is that when we have a 6, 7, 8 year kind of a cycle, in that cycle, 1 year is negative and rest of the years are positive. But that negative year is so negative that it takes away the returns of even the previous year, right? In the negative year, you lose some 25%, 30%, which means it not only that year is gone, but that 30% fall is so bad that it takes away the previous year's returns also. So when we say that the market has been giving on average some 14% return over the long term, it is 5 good years and effectively 2 years are wasted, or maybe sometimes 3 years are wasted. So when the years are good, you're supposed to make more than 14-15% return. So that the annualized return when after the losses will be this range. Now, why we think that this is not the end but a start is A, that over the next 6, 8, 9, whatever number of months, interest rates will be cut. Over the 5, 6 next months, the FII flows and the domestic guys might combine. Combine means that both wanting to buy. For the last 18 months, not these last 7 months, I mean before that, that means 18 months ending in December 22. That means start from say June 21 or something. The FIS sold maybe 35 billion dollars, and that was matched by Indian SIP or whatever mutual fund flows. Now the normal situation can be that both want to buy, which is what is happening these days. But this is the natural path. One selling, one buying is not the natural state. The natural state is the domestics are buying and the foreigners want to buy, because that is what foreigners normally do. In the last 20 odd years, maybe there have been only 4 years in which they have sold, and the other 16 years they have bought. They're supposed to buy every year, just like because every year there is savings, there is some GDP growth, some savings, and people buy. So you are making in this 15% range plus minus. What is the, this thing can go on. It is supposed to go on forever. But the problem is that 1 year you'll make 25% return, and then next year you'll make 25. So you'll have to give up in some in between or
Absolutely.
third year. That's the way. But over time, this is just going to go on like it has for 25 years, or actually for life. Even before we were born, the market was been going up. This is world data you can find on Google. You can, why don't you look at, you just search on Google 200 years of US stock market data. You'll get it from a book by Jeremy Siegel. And you can see 200 years of data. Basically, markets are supposed to go up. And even the US market for the last 25 years has gone up like 8%, if I remember, or 7 point some percent in dollar terms. Even that market has grown 12% per annum for 25 years. Why are we getting excited about this being the end?
Okay, so basically, it's a compounding machine that
Correct.
the market is, whether it's in India or in the US. Buy quality, stick to it, and look at outperformance, as Mr. Arora said. Don't worry where the markets are headed. It is in their nature to compound. The other questions, Samirji, are coming in from Twitter. It's Mr. Saurabh Nima from Indore again. He wants to know, how will the United States and other countries be affected by Fitch's downgrade of the US rating?
I think everybody's forgotten about it except our Twitter friend. I mean, first of all, there are 3 or 4 rating agencies. One of them, I think it was Moody's, which had already done it before, and now it is Fitch. So these things don't matter beyond a point, because first of all, the US debt is in dollars, and US can print dollars. So in theory, there should be no downgrade. The downgrade happens because a company is being downgraded because they can't conjure up dollars, or a Indian government cannot create a dollar from nowhere, whereas the US can. So this AAA or AA plus, nobody really cares beyond the point.
Absolutely. And the final question is from Shoaib Kalatra from Dubai. He wants to know, how will the market react on upcoming election if any change happens to the existing ruling party?
If the ruling party is not there at all, not that it has less seats, then the market will fall, I think, in one day, maybe 15-20%. And then it'll take you 1.5 years, and then you will recover. I think like we generally recover from every shock in the past 25 years, where the returns have been very, very good. You have seen every kind of crisis, including the fall of the previous BJP government when the market fell 17% in a day, or lockdown, or demon, or Ketan Parekh scam, or 100 Kargil, or US sanctions even on India, which I think people don't know, in 1998 because of the nuclear test. So everything that can happen has happened in India, and we broadly know the range. On day one, it will be a shock and you will lose 15-20%, but then you have to stick around and then slowly recover it.
Mr. Arora, what happens if the existing dispensation comes back into par?
That depends on what we build into the market from here to there. Maybe it'll go up 3-4%, because then by that time people would think that it is happening anyway, and the only thing would be on the downside. So right now there is very low expectation of them not coming back. But yeah, if it happened that day, you cannot say that it is okay, that it will fall. There is no question about it. And then over time, just like every other shock, it will be recovered.
Our final question, Mr. Arora, it's been wonderful listening to your views. What can derail this wonderful party that we are having on Dalal Street?
So, first of all, the issue in our life has been that whenever some risk has come, we have never thought that this also is a risk. We never imagined that this is also a risk. So, the last one was COVID, which who would have imagined? So, the point is basically just look at the last 20 years and see all the things that the world has seen, or India has seen, or I have seen as a fund manager, including Asian crisis, Russian crisis, global financial crisis. One government fell after 13 days, which was Mr. Atal Bihari Vajpayee's government, I think, which was in 98 or something. And then all this Cargill, and then this crisis, that scam, then demon, everything has happened. And life moves on. So you have to then that day remember that you are not to run away. You may add, which is perfect, but if there's not much new money to add, stick around and over time add. Look at it if you want confidence that in 1939, if you had invested in Japan before the World War even started, and in the end, the biggest loser was Japan. In 1939, if you had invested in Japanese equities, you did better than if you had invested in Japanese debt. So the equities over time, if you want to see another example, which I present in some of my presentations, if you had invested in 1929 October in US, which was when the recession, the biggest recession before 2008 started and went on for 7, 8 years, and the market fell actually 80%. You did better investing in equities in 1929 October than in US debt in 1929, provided that whatever dividends you got along the way, you have to reinvest. Because when the market fell, the dividends did not fall as much. And therefore, you were able to buy more units of the market. And then when the market recovered, basically you recovered all the underperformance. So the point is, don't think too much of the super bad because then you cannot do anything.
And finally, Mr. Arora, when do we see your license for Indian operations come into existence? The AMC that you were supposed to bring into the market, time is running by. We are already at 20,000 on the Nifty.
So we have got in principle approval and we are waiting for license, which we are supposed to get sometime. One day we'll get it and then we will get going. But we are otherwise ready, so we have to wait for the license.
So here's the best of luck to the second innings in India. Alliance was a phenomenal party. I saw all of it from 1998 to 2006, and we hope that this time the party gets better and lots more participation happens, and all of your unit holders and existing customers as well as you make tons of money in this bull run, which is yet to start, according to Mr. Arora.
No, not yet to start, but sort of just in the early stages. Nothing to get super excited about yet.
Thank you so much for your time. It is
Thank you
always such a pleasure listening to you. So that, ladies and gentlemen, was the effervescent Mr. Arora talking about everything under the sun, from US debt in 1929 to Japanese equities to local growth projections and where the markets are headed in the longer term. Thank you for joining us. Remain glued to BTTV for such fantastic interviews and such wonderful guideposts on what to do in markets such as ours. Thank you.
Hello and welcome to Business Today Television. I am Siddharth Zarabi and you're watching our special coverage of the